Good morning, Brianuts. Welcome to the fourth episode of the Seasoned Trader Ep4. My name is Ram and I will be your host for this evening. And on the other side is Aryan, our very own Seasoned Trader. To everybody who's attending this AMA for the first time, let me just introduce the series to you. The Seasoned Trader AMA series is where we, along with our seasoned trader, Aryan, teach our community how to trade. And we have started from the basics. The first episode, and we have come this far to the fourth installment. If you are looking to see the previous episodes, you can go to our YouTube channel. You can find it on our Discord or on our website, or just ask us. We can ping it to you. Now, to the concept of this episode. As soon as I heard what was going to be taught or going to be shared in this episode, I became very interested in it. I'm naturally very invested in this series, but this episode takes the cake because it's something that I have been very passionate about ever since I've gotten to know it, from other traders or in my own strategies. And Aryan is very passionate about this particular series. So I'm sure that this is going to be a very interesting class, and I look forward to listening to it and witnessing this class along with you. If you guys have any doubts, there'll be a particular time frame where you can clear them. You can either put it on the text box or you can ask it through voice. Just do it and we will be happy to clear it. Along with that, if you have any other doubts, otherwise also, please ping us on the trading channels and we will immediately respond to you. Okay, let's dive in. Aryan, over to you.
Sure, Ram. Thank you so much for that intro. And as you rightly said, today's topic is extremely interesting. This is a topic which is quite often talked about, but very few people actually use it. Very few people actually know it. Just to make sure I am audible, right? Ram, if you could tell me if I am audible or not.
Yes, you are. Yes,
yeah,
you are.
Aryan, you're
Yes,
audible.
Great. All right. So as I was saying, this is a topic that is very often talked about, but very few people actually use it. Very few people actually know about this. And that is because it is truly a complex topic to understand and even a more complex topic to apply in real life. And that is why we are going to run a series in which we are going to start today with the very basics, and then we'll move forward with this theory. Now, the Elliot theory was discovered by Aryan Elliot back in the 1920s after studying decades of market data. So it's almost a century old theory that was developed by Aryan Elliot, who was a genius of his time. He studied decades of market data and then found out that there's this theory that fits very, very well into our markets. Now, what differentiates this theory between all the other tools that we have is that this tool is something that nature gave to us. Unlike any other trading tool, whether it is moving averages, whether it is RSI, whether it is Bollinger Bands, all these tools are man-made. But the Elliott wave theory is something that the nature gave us, and I will explain you how. Now, before we start with the main crux of this session, let me just give you a recap of what we did before in the previous session. In the previous session, we went over 3 high probability chart patterns. And in case you missed it or you want to get a recap, you can go to our YouTube channel and you will find the video there. We will also put up a link in the chat box so you can get access to that video from there as well. All right, so getting back to our topic. As I told you, Aryan Elliot discovered this theory almost a century ago. Now, this theory is based on something that is called the Fibonacci ratio. And the Fibonacci ratio itself is also derived from Fibonacci number series. Now, what is this Fibonacci number series? It's a series of numbers that starts with 0 and 1. And going ahead, it is the sum of the previous two numbers. So 0 plus 1 gives us 1. 1 plus 1 gives us 2. 2 plus 1 gives us 3, 3 plus 2 gives us 5, and that's how it keeps going on. Now, what is so special about Fibonacci numbers? I believe these numbers are God's favorite numbers because He has used these numbers everywhere in nature, whether we look around or whether we look at ourselves also. To give you an example, lily has 3 petals, buttercups have 5, chicory has 21, 34 petals is what daisy has. So all these numbers are Fibonacci numbers. And not only that, even if we look at our own body, we have 8 fingers, each finger has 3 bones, we have 2 thumbs, and each thumb has 2 bones again. All these are again Fibonacci numbers. So this theory is based on these numbers, and I'll explain you how later on. Now, from this Fibonacci series, we get something that's called the Fibonacci ratio. This ratio is also called as phi, which is phi. It is also called as the golden ratio. Now, to better understand this, I want to give you guys a small task. I want you to take any number from the numbers that are appearing in front of your screen right now and divide it by the number right before it. So, Ram, if you could just give me a number, I will.
How about 610, Aryan?
Sure, if you could repeat.
610. And the number before it is
610. Got it. So 610 is the number. The number right behind it is 377. Now, if you see, the number that we get when we divide it is 1.618. Right? Even if we take any other number, if you could give any other number, Ram.
144?
Sure. So 144 is the number that Ram gave me, and the number right behind it is 89. And when we divide 144 by 89, we get 1.617, which is quite close to 1.618, right? And this is true for all the numbers that are there in front of your screen. So if you take any other number, be it 4181, be it 2584, any number on your screen, and you divide it by the number behind it, you will get 1.618, right? And this is the golden ratio. Now, this golden ratio again is extremely common in nature and in fact in our human body as well, and it's very commonly found. Whether you look at our ears, whether you look at a seashell, whether you look at our hand, whether you look at our body itself. To give you an example, our navel divides our body into the ratio of 1:1.618, in which the lower half is 1.618 times the upper half. Now, combining Fibonacci ratio and Fibonacci numbers, we get the Elliot wave. All right, so now that we have covered the Fibonacci ratio and the Fibonacci numbers, let's start with the very first and the most basic pattern of the Elliot wave theory. And that is the impulse pattern. As the name suggests, impulse patterns are very fast patterns which have a lot of strength and a lot of volume. They have 5 waves within it. Okay, so again, 5 is a Fibonacci number. Keep this in mind. They have 5 waves within it, in which 3 of them are in the trend and the other 2 are counter trend. So wave 1 goes with the trend, wave 2 goes against the trend, wave 3 again goes with the trend, and wave 4 again goes against the trend, and then lastly we have wave 5 which goes with the trend. All right, and this impulse wave is so fast that when it actually happens in front of your eyes, it will not give you the time to enter or exit the market, because the prices will be fluctuating so fast that by the time you enter the price and you punch in the order, the price is already gone. Right. The next type of pattern that we are going to study today is the corrective pattern. Now, the corrective pattern has a lot of subcategories, but generally the corrective pattern has 3 waves, which is A, B, and C. Now remember, impulse wave is counted from 1 to 5, whereas corrective waves are counted as A, B, C, D, and so on. Alright, so generally corrective waves have 3 waves. They have 2 waves which are in the trend and 1 wave which is counter trend. So A goes with the trend, B goes against the trend, and then C goes again with the trend. Now, corrective wave is absolutely opposite of the impulse wave. The corrective wave is slow, it has low volume, and as I told you, impulse is the exact opposite. It is fast and it has very high volume. And this is what makes corrective waves very, very complex. It has a lot of sub waves within it, and when you look at a corrective wave, it becomes very difficult to identify different waves within it. And that is why we generally try to stay away from corrective waves. So when a coin is correcting, we try to stay away from it because it is very difficult to identify in which direction it is headed next. Now let's see a real life example of both impulse and corrective waves. Can you guys see my screen?
Yes.
All right. So right now, in front we have the BTC USDT chart, and on this chart, we see an impulsive move. And how do I know that it is an impulsive move? It is because it is fast, it has high volume, and it has 5 sub waves. And let me count it for you. So the first sub wave is this. The second goes down. The third goes up. Fourth comes down again. And the fifth goes up again. So we have 5 sub waves in which 3 are trending, 2 are counter trend. We have very good volume and we have the swiftness that we want in an impulse. All right, let's look at another chart. If we look at this small impulse wave, we can again see that there are 5 waves in which the first goes up, the second comes down, third goes up again, fourth comes down, and then fifth goes up again. Let's see the last example, and then we'll move on to the corrective waves. This is the ADA USDT chart, and on this chart we can see that we have the first wave here, the second wave was corrective, went down, third wave went up again, fourth wave went down again, and the last wave also was trending upwards. So here we have the 5 wave impulse. Now looking at corrective waves. So if we look at this second wave, we can clearly see that it has 3 waves within it. It has 3 waves within it, in which the first A wave goes down, the B wave goes up, and the C wave comes down again. So this is a typical corrective wave in which we have three waves. If you can see, the volume has dropped and it is slow compared to the previous impulse. And after the second wave is over, we then again start with a new impulse in which the market goes up. Let's look at another chart for this. If you look at the second wave here also, we have clear three waves. The first wave goes down, the second wave goes up, and the third wave goes down again. All right, so A goes down, B goes up, and C again goes down. So these were the examples for impulse and corrective wave. If you guys have any questions, please let me know. If you guys have any charts that you would like me to show on the screen, please let me know that as well.
Actually, I have a question.
Sure.
You were telling me that waves could exist within waves, right? Can an impulse wave exist within the other wave? Will it be only like, will they be alike or can they be unlike?
Very good question, Ram. I will tell you. So, to cover this, let me make you understand a topic which is fractal nature. So, Elliot waves are fractal in nature, which means that every wave is a part of a bigger wave, and every wave has multiple sub waves in it. You can think of it as a spider web. So, spider web, there is a big web, there's a smaller web within it, and then there's a smaller web within it. So, there are multiple webs within one web, and each web is a part of a bigger web. So, if we look at this impulse from 1 to 5 and then this correction from A to C, we will see that the first impulse has the first wave has an impulse within it, and the second wave has a correction within it. The third wave again has an impulse within it. The fourth wave again has a correction within it, and lastly, the fifth wave also has an impulse within it. So, to answer your question, yes, we can have corrective waves within impulse wave, and there can be impulse waves within corrective waves. To show you, this wave from from 1 to 5 is an impulse wave. But if we look at the wave 2 and wave 4, we will see that these are corrective in nature because they have three waves within it. So we have A, B, C, which is three waves, but it is a part of a larger impulse wave. Again, here, if you look at A and if you look at C, these are impulse waves. Why? Because they have five waves, 1, 2, 3, 4, and 5. But they are a part of a larger corrective waves, which is the ABC. All right. So I guess we are almost done with the session now. If you guys have any questions, please let me know. After this, we're going to move to the quiz.
If I may ask another question.
Sure. Now.
When is it too early to decide if a wave follows the Elliot theory? Or when is the precise time for us to get to know that this wave is actually like the golden ratio is actually taking place? Like on the screen. How quickly can I assess it?
Good question, Rob. So to understand that, of course, we will have to go over a few more sessions. I think right now it's too early to figure out whether it is a corrective wave or an impulse wave, whether the market is trending upwards or it's going to go down, right? As I told you, it's a very complex topic, and that is why we have started from the very basic, right? Once we have an understanding of the very basics, over the next few sessions, I think we all will be trained enough to identify whether it's an impulse wave or a corrective wave, and to decide whether the market is going to trend up or down.
Okay, Yeah, cool. I'm looking forward to learning it.
Sure. All right. So let's start with the quiz. The very first question that we have for today is, look at the chart here, and do you think the breakout that we got here is a valid breakout or not? You guys can put in your answers in the chat box as well.
We have an answer. It's from Fermontiel. I hope that I'm pronouncing that right. The answer is not, because he's telling it. They are telling it's because it's a resistance. That's one of the answers.
Okay. Right. Your answer is absolutely right that this is not a valid breakout. But if you could give me any other reason apart from that, I'll give you guys 30 seconds and then I'll tell you what the actual reason is.
There actually is an answer.
Yeah, very good answer.
Yeah. Lack of volume is what they're telling.
Yes. Very good answer. You're absolutely right. It's because if you look at the volume bar here, it's way higher than the volume bar that is here. So that gives us the confirmation that this is not a valid breakout at all. And the other thing that we can clearly see here is that when the price broke this level, whichever this level was, when the price broke this level, it was not able to sustain this level, right? Very quickly, it went below this level and it started trending downwards, right? So these are the two main reasons. One that you guys mentioned, that the volume is less, and the other is that the price was not able to sustain itself. It fell back down very quickly. All right, let's look at the second question. All right, looking at this chart, what do you think will be a good decision? Should we buy here or should we look to sell from here?
An instant answer. Buy.
Okay.
For this letter, yes? Because there is high volume.
Okay, valid reason. But I'll wait for another 10 seconds. All right. So you rightly said that the volume has increased, but what we should also consider is what is the main trend of the market. And I think I'll take you back to the very first session that we had, the very first AMA that we had. And in that AMA, we discussed that the most important thing in the market is to look at the main trend. And here we can clearly see that the main trend is downwards, right? The market has been falling again and again and again, right? Although the market was able to recover a bit here, it was able to recover a bit here as well. But the main theme, the main trend of the market has been downwards. And that is why, even though the volume is higher, I will not look to buy here at all. I will rather look to sell. And in fact, the higher volume gives me the confirmation to sell. Now remember, volume is relative, right? It is not an absolute thing. When volume increases, as the price increases, that means that the strength or the bullishness has the support of volume, right? But when the price is falling and the volume is increasing, that tells me that the fall in the price has weakness in it, right? And that is why the best decision here will be to sell.
Please continue, Aryan. I'm sorry, guys. Just a quick note. If there's any questions you want to ask, there'll be a specific time given to you where you can, or you can just reach out to us on time.
Yes, another good point noted by our users is that there's a lower low, right? There's a lower low, not a higher low, there's a lower low. And that is why we will look to sell. In addition to the main trend being downwards, there's also a lower low. The volume is also increasing while the price is decreasing. And that is why we will decide to sell here and not to buy.
I think we have a very good trader amidst apart from Aryan here.
Yes, absolutely. I think someone is trying to ask or say something. Could you please type it down in the chat because you're slightly inaudible. All right, anyways, we are here at the very last question and the third question, and that is related to the session that we had today. How many waves does an impulse pattern have? We covered it very recently. I think you guys should be able to remember this one. Remember, there were two kinds of waves. So there's an impulse wave and there's a corrective wave. And both of them have different number of subwaves. All right, I'll wait for another 10 seconds. I've received an answer, but I don't think that is the right one. All right, so the right answer is that the impulse pattern has 5 subwaves and the corrective pattern has 3. Let's go back to that slide. And you can see here that the impulse has 5 waves, right? 1, 2, 3, 4, and 5, in which 3 of them are trending and the other 2 are counter trend. And the corrective pattern has 3 waves in which 2 of them are trending and the other one is not trending. It is in the opposite direction of the trend. All right, now that we are done with the quizzes and we are done with the main topic for our session, in the end, we are going to have a market analysis in which I am going to analyze the Bitcoin and the Ethereum chart. And just to give you guys a heads up, we are also having the Trade Rush trading competition. You can use the market analysis that we're going to do here right now to carry out your trading and to generate some profits on the Prime account. All right, so we are here on the Bitcoin chart right now. And on this chart, you can see that after getting a very nice rally, we had a correction. And from the correction, it has started to trend upwards again. And lately, the market has been extremely bullish. I've been getting messages again and again about, that the market is going to touch 100,000 or, 1 million. So yes, of course, the market has been extremely bullish lately. But what I see here is that the market has reached a point which appears to be some sort of resistance to me. And I'll tell you why. The main reason is that if you look at the chart here, there is some kind of congestion that we can see here, right? The price was consolidating here for a very long time. And that is the zone that we have entered back again, right? So till the time we were, below 35,000, I was extremely bullish. But now I'm starting to get a little worried, and that's because of this congestion zone that we have here. So what we can assume is that the market is gonna consolidate again here for a while, and after that, depending upon where it breaks out, we're gonna trend in that direction. All right. So we can expect the market to stay here for a while, maybe go up a bit. And then from there, if it breaks up, then we're going to see higher levels. In case it is not able to break up and it goes down, it breaks down, then we're going to see lower levels. So I think BTC has reached a very crucial zone right now. And I think for the next month or so, we are going to consolidate in this zone, which is the 38K to the 41K zone. We're going to stay in this zone for some time now. And then from there, we can, depending upon whether market breaks out or breaks down, we can expect the prices to move up or down. And we're going to cover that in our next session. Whichever direction the market breaks out or breaks down on, we're going to cover that up in the very next session that we have. Now let's move on to the Ethereum chart, which is more interesting. Now, in contrast to Bitcoin, we can see that Ethereum has been much weaker.
Aryan,
Yeah.
I'm sorry to interrupt you.
Sure.
There's a question in the chat if you'd like to take it.
Sure.
It needs to be answered within this moment, because if we lose context, it'll be gonna be a little bit like, yeah, that's all.
All right. He's asking whether it's better not to operate or not to trade. So I'd say, of course, on the larger time frame, it is slightly difficult to trade right now. But again, if you look at the lower time frames, right? If you look at the daily, or if you look at the 4-hourly chart, you can see that there's a resistance building up here, right? There's a resistance building up here. So of course, if we get a good breakout above this level, we can see levels to maybe 39,000 or post 39,000. So this level is much awaited in the shorter time frame. But in the longer time frame, of course, we are going to consolidate for some time from here. And then, depending upon where it breaks out or breaks down, we're going to see the market trend up or down. And I totally get it if you are new at this. All of us at some point are new to things, and that's how we get better at it. All right, we'll get back to the Ethereum chart. Right, so as I was saying, Ethereum has been much weaker than Bitcoin, and that's because Bitcoin has been breaking its high again and again and again, but Ethereum has not yet broken the previous high of 2150, and it is still trading below it. And if you zoom out a bit, you can see that we're actually forming a triple top, right? The first top that formed was here, the next top formed here, and the third top is being formed here. So depending on whether we are able to actually break out from this level or not, we can see the price push downwards. That's because a triple top is a pattern in which the price tries to go up again and again and again, but the sellers are so strong at that level that they keep resisting it. And at one point, when the buying power is done with, when the buying power is over, that's when the sellers come back in the field and they push the price down. All right. So it's very crucial for Ethereum to break this zone right now. If it is not able to break this zone, then it might, cause the prices to get pushed downwards, maybe to 1900 or even 1800 levels. So both Bitcoin and Ethereum at a very crucial point. Bitcoin is going to enter the consolidation zone, and Ethereum, on the other hand, is standing at a resistance zone. So if it is able to break out of this resistance zone, well and good for Ethereum, it's going to trend higher. But in case it is not able to cross this resistance zone, then we can see the prices getting pushed down. Now, in addition to both these charts, let's also look at the ETH BTC chart of how weak Ethereum is in comparison to Bitcoin. Now, we're looking at the Ethereum Bitcoin, and we can see that ETH has been underperforming since here. So after making the stop here, Ethereum has been underperforming time and again. And standing at this is a very, very old support line. And we are standing again on it. This is the third time that we have come back to the support line. Then we can see much lower levels on the Ethereum. All right, so we are done with the session. If you guys have any questions or you guys want to discuss any chart, please let me know in the comment.
Perfect, Ben, because there's one more question. In terms of time, how much ETH does have to show strength?
Correct. So from what I can understand from your question is in how much time should it break the... So if you look at the chart on the daily time frame, we can see that the market was trending up for about 7 days, and now it has for another 19 days. So it has time for the next 10 days. If it is not able to break out of this level, then we can expect Ethereum to fall down maybe another 5 to 7%. But it might so happen that we are able to actually cross this resistance zone and trend upwards. So it's a wait and watch game right now on the Ethereum chart. And Bitcoin, however, we are going to enter the consolidation zone and we're going to stay in that zone for about a month or so. Now, remember, all of this is for education purpose only. There is no buying or selling call that we are giving here right now. All of this is for you to better understand the market, better understand Ethereum and Bitcoin and how the chart is going to play out in the next couple of weeks. So focus on that. Make sure you do a recap of what we went through today about Fibonacci ratios, the Fibonacci numbers, and the Elliot wave theory. And we will be back in the next session with more such content.
Thank you, Aryan. That was a very good session. Some of our users also feel the same. Personally, I really love this because I've been looking forward to this session for a very long time. Ever since I heard that the topic was going to be about Fibonacci series, because I know a lot of traders who on daily talk to me, they use this quite a lot, and I've seen charts. I've seen Aryan use this strategy quite some time too. And it's great that you've been able to master this strategy and use it. And I'm really looking forward to all of us learning this from Aryan and using it in our daily strategies. Now, there seems to be a message. Yeah, really good session. Yes, I know, right? For the final part, I would like to take 2 minutes of your time so that I can tell you about how the month of November was for Brian. It's been a great month. We've all been working hard, and our community has been doing very well too. And the month of November saw us launch two new networks on our platform, namely Scroll and Starknet. If you guys were aware and if you were following us on our Twitter and our socials, you would have been you would have known how big this was. And three new pairs: Link, MKR, and Aave. And something even more personal, and I'm really happy about, is our socials. Our Twitter has crossed the 50,000 mark, which is something that's really exciting. Which is something that we've been looking forward to for a very long time. And our Discord too has crossed over 35,000 users. And to mark the occasion, we recently did a revamp, right? If you guys remember how our Discord used to be a few days ago, it's more efficient, it's more simple, everything is available to you at a quick glance. You can reach out to us immediately, right? And we've all been working with the community very closely to ensure that our users are feeling heard and they're feeling, that their concerns are being addressed. Apart from that, Trade Rush has been a very new concept. The concept of trading, it's actually, there's a very nice sequence to it. There are 2 days, 2 pairs, and a few couple of winners only. Right? 2 days, 2 pairs, and 2 volumes of it. This month we've had Trade Rush and Trade Rush V2. It's a nice number game, right? Just like Fibonacci. And finally, the Discord got revamped. That is all for the updates I have. It's been a very interesting month. It's been a very exciting month. And our vibe here has been sky high. We're on cloud 9, and we aim to go through the next month with the same amount of enthusiasm. So stick with us and keep in touch with our socials for more information. See you on the next session. If anybody had any internet issues in the middle, please wait for this to be uploaded on our YouTube channel. It will be up very, very soon, and you can catch it there. If you have any questions at any time of the day, please feel free to put a message on our channels, on our blind trading channels, or reach out to us. And we will get back to you immediately. Thank you, everybody.